Hi guys, welcome to chapter 17, video number 2. There's only 2 videos in this one. It's a short and easy chapter, as I mentioned in the first video. I have 2 sample problems here that mimic your lab problems. The first part of this is problem 1730B on page 949. And it's just like your homework problem, your lab problem 1723A. It's a trend analysis, which is another form of horizontal analysis. And I did it all up ahead of time, as I've been doing, to save time and make it neater for you, because as you know, my writing is not great. But it's better when I do it ahead, and that's what I did. So I'm going to go through this problem, and then the next one is on the other side behind me. I'm trying to kind of stand in front of it so it doesn't confuse you too much. But again, this is like your first lab problem, which is P23A, and this is 1730B, page 949. Okay. So this one is, they're giving you net sales, net income, and common stockholders' equity for Asbel Mission Corporation, a manufacturer of contact lenses for a 4-year period. And I have the 4-year period all mapped out here. Trends mean trends from year to year. They're usually done from 3 to 5 year span. You pick a base year that you want to go off of. They've chosen 2016. So assuming it's the end of 2019 here, they're going to do everything compared to 16, how they've done in these 3 areas: net sales, net income, and common stockholders' equity. And a trend, again, it's another form of horizontal analysis. We're going to use our base year, the beginning of the trend, 2016, as the 100%. So that's always going to be the denominator. We're going to compare each number, which will be the numerator. 639 in 2017 actually is less revenue than the base year, so it comes out to 97%. I didn't have room to put the math. I had time, but not room. But it's just 639 divided by 659,000. That's where we get the 97%, and it's rounded to the nearest percentage. People have been asking me about that, about rounding. You always round it up or down. So in this case, I can't remember exactly how it came out, but that's you round to the nearest whole percentage point. So 97%, 2018. We actually go higher. It went up to 701 net sales. So 701 over 659, we get 106% of the base year. And then in the most current year, 2019, went up again to 758,000. If you put that over the base year, 659, you get 115%. It's a very easy calculation, as all ratios are, thank goodness. And this chapter is full of them, okay? Most of them are all review. The ones I highlighted are some of the new ones that we haven't done before, like the horizontal and vertical, which we're going to do in the next piece. So then we do the same thing for net income. The base year is 42%. Went down to 39 in 2017. That's 93% of the base. 2018, 40,000, 95%. So we still haven't gone over in the 2 years after the trend was begun. But then we did in 2019, 59,000. It's 140% of 42,000. Right? So it started out slow. We dropped, and then big increase in 2019. As you can see, that is a good year for them, for sure. Then the last one, common stockholders' equity, started in 2016 at 302. That's going to be our denominator. Here are our numerators for the 3 years in the trend. 324, we got 107%. They're all above the base year. 346 over 302, 115, and then 360 in 2019 is 119% of the base year. And that's how you do a trend analysis, okay? As I kind of went over quickly at the end of video 1, the trend is usually taken 3 to 5 years. I think the one in the book also does 4. So, requirement 2 in this problem is to do ROE, return on common stockholders' equity, which comes from Chapter 13. It's our ratio problem in Chapter 13. I abbreviated ROE for the rate of return on common stockholders' equity. It's net income over preferred dividends. That's the numerator. There's no preferred, and this company does not have preferred stock, so that's 0. Over average common stockholders' equity, which is beginning plus n divided by 2. So we have to do 3 years, 2019, 59,000. I put the minus 0 just to correspond with the formula. And then the common stockholders' equity, 360 plus 346 is 706,000 divided by 2. Here's our average, 353,000. Divide the 59,000 by the 353, you get 16.7%. They want 1 decimal place here for the ratios, as usual, okay? So 1 decimal place when you're doing the ratios. So 16.7 for 2019 turns out to be the best of the 3 years. I probably should have started with the earlier year first, but this is the way I wrote it. So let's go to 2018, the year before. We had 40,000 in net income over, we have to get the average, 346 plus 324 is 670 divided by 2. The average is 335,000. Divide 40,000 by 335,000, you get 11.9. You get a decimal and then you change it to a percentage with 1 decimal point. The earlier year, 2017, when we only had 39,000 in net income. Okay, so that's our numerator. Denominator, 324,000 plus 302. 626,000 divided by 2. Average 313,000. Here's our rate of return on equity, 12.5, 0.125. So you can see, and I probably should have gone the other way, 17, 18, 19. But you can see, just like it corresponds up in the trend, the common stockholders' equity rate of return improved as we went along. So a very positive, or as they say in finance, favorable trend. Okay? So that's the first part of this. Now I'm going to kind of switch around and cover this up and go to the second part, which is Randall Department Store. Let me just get this so you can see the whole thing. Randall Department Store is on the same page. It's down at the bottom. And this is a vertical analysis problem. With a vertical analysis, we're going to compare everything to the significant account on the statement. And for an income statement, that would be net sales revenue. And for a balance sheet, which is down here, that would be total assets, which means it's going to be the 100% and always the denominator. So with the vertical analysis, we're going to compare each account on the statement to its significant account on that statement. Again, sales for income statement, total assets for balance sheet. As you can see, I made a mistake and I put requirement 2 before I finished requirement 1. So I'll go over both pieces of requirement 1 and then I'll talk about requirement 2. This is supposed to be down here, but I wasn't erasing it, so I left it. So what they say in this problem, they give you Randall Department Store and they ask you to compare the company's profit performance and financial position with the average for the industry, which is very common with vertical analysis. Horizontal as well. The CEO has given you the company's income statement and balance sheet as well as the industry averages for retailers. So you can see if you look at the two statements on the bottom of 949, or if you're on the computer and you can see them on your problem in Pearson, you can just click on the icon to get them. It gives you Randall's information and then the industry average. So we'll talk about how they did against the industry average in requirement 2. In requirement 1, we need to do the vertical for the income statement and the balance sheet. So income statement first, we have all the numbers. Just have to copy them. Net sales revenue, cost of goods sold, gross profit. And then operating expenses, operating income, other expenses, and net income. That all comes right from the book or the little icon in Pearson. What they want us to do with these numbers is do a vertical analysis and use our net sales revenue as the denominator. So for all these percentages I put in, the numerator would be the account, 527, 742, and the denominator is always the sales. So cost of goods sold is 67.4%. They want one decimal place. Gross profit at 255, 258 is 32.6% of 783. Everything goes against the denominator of the sales. Operating expenses, 20.9% of 783. Operating income, the 91,611, 11.7% of sales. Other expenses, 0.8 of 1%, less than 1% of the total sales. Net income at 85,347, 10.9% of sales. So you could say their gross profit margin is 32.6%, their net profit margin is 10.9%. We'll see how that stacks up to the industry average. But first we have to do the balance sheet. I'm going to come down here for that because it's low. Okay, so I kind of cram this in a little bit. So we have all of our numbers right from the book, okay? Current assets, property, plant, and equipment, that's PP&E. Intangibles, other assets, and total assets, that's our base amount, okay? Always the denominator. Put in all the numbers. List the current liabilities, long-term liabilities, total liabilities. Oh, I'm sorry. Current liabilities first, long-term, total is 314,640. That's all from the book. And then here's our total stockholders' equity at 145,360. All of these accounts will be the numerator up against the 460, the total assets. You could also say liabilities and owner's equity, but they're the same number. Okay? So as long as 460 is your denominator, total assets, or total liabilities and stockholders' equity, always the same because one equals the other. So 45.8 for current liabilities against total assets, long-term, 22.6% of total assets. Total liabilities, the 314,640, 68.4% of total assets. Okay? So you can say your debt to equity, so to speak, debt to assets, total debt, all of your liabilities over total assets, debt is 68.4. And we'll see how that stacks up against what the industry is. So our total stockholders' equity at 145,360 is 31.6%. Notice the total liabilities and stockholders' equity is 100%, just like total assets. Okay? So that part, it is a pretty easy formula to do. Okay? And the reason I chose to highlight these two problems, again, you have it as part of your assignment, and also we haven't done these type of analyses before. So in the kind of what do you think part, requirement 2, they ask, compare the company's profit performance and financial position with the average in the industry. Now, if you recall on the page before, again, if you don't have your book out and you're just looking at the little supplemental icons they give you with the balance sheet and the income statement, you see in the second column there's Randall and then there's the industry average. So you can make some comparisons there. And the first one I highlighted was the gross profit and the profit margin ratio, which if we go back to the income statement, remember 32.6 for gross and net income, the net margin was 10.9. If you look at the industry average is better, right? Their gross profit margin is 34.2 to our 32.6. And the net is 14.1 compared to our 10.9. So our financial position isn't as strong with these numbers, the gross and net margin, as the industry. That's the first thing. And then another thing, if we look at the balance sheet, they have Randall has a higher investment in plant assets, property, plant, and equipment, and intangibles than the average. If you look at the average on the balance sheet, our average for current is okay. Property, plant, and equipment, ours is 26%, industry 23.6%, and the intangibles 0.8%, and we have intangibles 1.6%. So we're not terribly higher, but slightly higher, showing we're investing more in those assets. Not necessarily a bad thing. It could go either way. The profit margins are more significant, I thought, but I thought that was worth noting. And then the biggest thing, the percentage of debt to total assets, really shows a weakness here, financial position weakness against the industry average, because, and I think I mentioned it just a couple of minutes ago, we have a 68.4 total liabilities to total assets, the 314,640 over the 460,000, 68.4. If you look at the industry average on the income statement, not on the income statement, on the balance sheet, it's only 64.7 total liabilities to assets. So it's quite a big difference there. We have the 68.4, it's about 3.4 points different, percentage points difference. So it's pretty significant. It shows that between the first bullet point and the last one, that's a significant weakness that they have, that they need to work on. And that's what's so great about these ratios. They really pinpoint strengths and weaknesses. The second one could be considered a strength because they do invest a lot in their plant assets and also intangibles. So that could help them push these numbers more towards the average. That's it for our video 2, and I will see you next time for chapter 18. Good night, everybody.